On Talking Point today, the case for a chat. Well, with the guest that we have, and one of my favorite economists, we have to talk about what the recency of print, both on inflation globally and in India, as well as growth numbers, both globally and India, hold in store. Of course, yesterday's news around Indian bonds also included in the Bloomberg bond index from 2025, Jan 2025, also make their way into the conversation today. Our guest is Pranjul Bhandari, Chief India and Indonesia Economist at HSBC. Pranjul, great having you. Thanks so much for joining in. And in advance to you and your colleagues at HSBC, a very happy Women's Day.
Thank you very much. Always lovely to be in your channel.
Yep, great. Always lovely to have you. Pranjul, I'm starting off with the worrying signs though. While the whole risk asset community was watching out for when does the commentary and the actual action around rates in the US happen, the recency in prints across core CPI or otherwise in the US isn't very pleasing. Jerome Powell yesterday said the same, which is that there is no number out there or no timeline out there. But my question to you is broadly that could the unthinkable of 2023 happen, which is that we may not see any rate action in 2024 from the US if inflation prints stay higher than what is envisaged?
These are great questions. If you take a step back and you look at global growth, it's actually doing very well. We just got the February PMI numbers for all countries, and global PMI is showing that manufacturing globally is now in expansion mode. Just 2 months ago, it was in a contraction mode. Services PMI is doing even better. New orders, future expectations are only rising across literally many countries. India obviously is spearheading all of this. Even in the US, the PMIs have done very well. Some of the ISM prints have been extremely strong. So generally speaking, it almost seems like growth, is much better now than it was a couple of months ago. Of course, there are problems, there are issues out there. For example, Red Sea, and we could see some fallout from there later, but it's not really being seen in the data, at least, right now. This brings us to inflation. And, as you mentioned, January US inflation looked extremely strong. It was higher than expected, more coming from services than from goods. And my sense is that, yes, I think this will make a lot of policymakers in the US more thoughtful about the rate cutting cycle than before. To be sure, I think if you look at a very Taylor rule kind of approach, there is space for rate cuts in the US. But because January inflation came in so much more higher than expected, I think right now all eyes are on February inflation. Will it also surprise on the upside, or will it show some softening? So there are lots of moving parts, and we are all prisoners of monthly data at this point of time. Our US economist does have his, Fed rate cut, first rate cut in June. I must say that he's had it there for like over a year now. Especially when markets were expecting rate cuts much earlier in the year, he was like a standout view. So from that perspective, he was expecting later rate hikes. But right now, because the Taylor rule suggests so, he's keeping to his June first rate cut. But of course, I think February inflation data will have a lot of meat there.
So what does that do to... Okay, what does a combination of what you just mentioned with regards to global manufacturing, so on and so forth, and if indeed the US inflation print is not benign, let's say, and you add to the fact that Indian central bank will not necessarily make a move on the downside if the US Fed is staying pat, and we have the Indian growth numbers looking the way they are. Does it kind of push back any kind of hopes that people might be having for the Central Bank of India to make a move in order to support growth?
Look, again, a great question. Growth in India has been extremely strong. Maybe later, if time permits, we can talk about the December GDP number. But actually, more important is the data that has been flowing in after that. The Jan and February PMI, for example. We've seen much better data in Jan-Feb than we saw in the last quarter of 2023, both for PMI manufacturing, PMI services. PMI services in particular, right now, if you look at new orders, it's at a 1-decade high. If you look at input prices, it's at a 4-year low, which basically means that corporate margins are improving a little bit in Jan-Feb compared to the previous quarter. So things are looking, really up at this point. And my sense is that when you have such a great, opportunity, that growth is extremely strong and there's no real pressure to cut rates, why not use this opportunity to bring down inflation to that 4% target, which you've been talking about a lot? So, yes, very long answer to your question, that if growth remains so strong and there are no rate cuts globally, my sense is that the RBI will not be in any hurry to ease. Even if RBI eases, my sense is it's going to be an extremely shallow rate cutting cycle. Because what is the need for rate cuts at a time when growth is anyway doing well, and things are on the right side, and inflation is not yet down to 4% or close to 4%.
No, no, not at all a long answer. We love listening to you, Pranjul. So please continue. But just I have a follow-up question to this. Your GDP note was that you need to calm down. That was the title. And then I hear you say right now that while GDP came at what it did, the PMI data is extremely buoyant. So do people really need to calm down or celebrate growth in India?
Look, I'll celebrate growth in India. I'm very excited about it. But I think the 8.4% number was, had a lot of statistical issues in
Yeah.
it. And that was my point. By the way, this title, "You Need to Calm Down," is actually a Taylor Swift song. And, Taylor Swift is in Asia this week. So I just thought it'd be a nice touch. But, that apart, my sense is that we need to look at the GVA numbers a little better than we look at GDP numbers. And I'll just tell you two quick reasons for it. GDP is GVA plus indirect taxes minus subsidies. It's all a little complicated. It should normally be all right, but there are two reasons why a divergence between them can sometimes creep up. One is a very India-specific reason: the fact that when we pay out our subsidies, it's cash payout. It's not accrual accounting. So what we do is that even if the subsidies for December, but if we pay it out for March, then the whole thing will be shown for March and not for December. We do cash accounting, and that messes up the number a bit. The second is global. These are very different times, right? We're seeing commodity prices go up and down. In the December quarter, we saw a 65% year-on-year number in terms of fall in fertilizer prices. That also brought down the subsidy bill. The subsidy bill was extremely low, because of which the GDP turned out to be much higher than GVA. It really doesn't have very much to do with the growth on the ground. So if you want to get a sense of growth on the ground, it's better if you follow GVA, particularly given some of these little things that creep up into GDP, especially in India.
So Pranjul, I mean, GVA per se, relative to the rest of the world, even if the GVA numbers are looked at, one, probably not as bad. Yes, we not have that fancy 8% print, but not a bad print. But the addition that I'm making to that is that while even if you look at the GVA, the GDP and looking strong, consumption isn't quite firing. Now, is that a reason or a cause for concern? And can any regulatory action or a policy action amend that, or it will only stem out of confidence and wage growth?
Yeah, I'm very happy you asked this question, because my sense is that consumption growth, which we are seeing in GDP, is underreported. And my sense is that in subsequent revisions, which will happen, between next 1 to 3 years, this consumption growth number will be revised upwards. I'm saying this because, we are seeing investment growth being strong. Over a long period of time, if investment growth is strong, then consumption growth is also, stronger than before. They move together, because people who are working in this investment construction sites are earning some wage which they can spend. Even if it's capital intensive investment, the owners of capital get remunerated. So my point being that you can't have such a huge divergence between investment and consumption. Couple of other points. If you look at GVA personal services, which is hidden in the GVA, that's extremely strong. That's 7.5%. That's personal consumption, and it doesn't match with the 3% private consumption that we get in another part of GDP. So I think there is some problem going on here. Finally, look at bank credit data, right? If you look at personal loans, you take out mortgage. So personal loans for non-housing, even that is extremely strong. And a lot of that is there to fund consumption. And sorry, one more final point. If you look at consumer imports, they are on fire. They are 50% higher than pre-pandemic levels. So when I put all of this together, it seems to me that this about 3% private consumption growth, which we are seeing in national accounts, is a little bit of underreporting. There are a lot of issues here, but I think in the next couple of years, it'll get increased a little bit.
Okay, so you're saying there are challenges to capture this well, and those challenges will get ironed out, which will result in the correct reportage, which according to you will be higher than what it is showing right now.
Yes,
okay,
that's correct.
The other thing, Pranjul, and I don't remember it exactly to the T, but you tend to bring out these points wherein you look under the hood and look at what's happening to data which is not quite visible. You had mentioned some time back, if I'm not wrong, that when you looked at the rural balance sheets, and there was some high frequency indicators which indicated that that part of the market was not hurting as much as is widely believed. Now, this was maybe 3-4 months ago. Some time has passed from now until then, or then until now, excuse me. Is that trend continuing? Is rural a lot better than what the market is fearing?
Yeah, I think I'll hold on to that view. Look, at no point am I saying that rural is like rising rapidly. It's not, particularly because last year was an El Nino year and the Kharif production was weak. And, we know that there were a lot of stresses out there. So I'm not saying rural incomes are doing extremely well. But at the same time, I don't think there's rural distress because that alternate employment in construction sites has really picked up. A lot of people are working in these construction sites and sending money back home, which I can actually track from some of the remittances data that we get. If you look at cash balances in Jandhan accounts, which are mostly rural, those are also higher than before. So I do think that things are not as bad as they could have been if we did not have this construction boom in the economy that is going on at this point of time. But having said this, I do think that there are signs of K-shaped recovery. I'm not against that point because one group of people is doing much better than another group of people, right? Like I think one strong source of growth in the country in the last couple of years has been professional services exports, the advent of global capability centers. People associated with those high growth sectors are doing much better than somebody who's in rural India and is having to grapple with El Nino. So a K-shaped recovery is there. But my small point is that the rural distress is not as much as a lot of people have made it out to be because they have alternate source of income from construction.
Got it. Pranjul, one final question, and that is on yesterday's announcements around Indian bond inclusion in the Bloomberg bond index as well from Jan. So we have JP Morgan from June this year or thereabouts, then 6 months, then Bloomberg index as well. How material, I mean, we know it's material, but how material from a 2-3 year perspective would a combination of these two and some other indices be for the bond market depth?
Yeah, so we got the announcement in September last year for inclusion into JP Morgan, the emerging markets index. And actually, it's going to start in June, but already in the run-up, we've seen since October $10 billion in India's bond market. So it is substantial. And my sense is that when the actual inclusion happens in June, then we'll get even more money. So that is exciting. And then we got this announcement yesterday for a similar inclusion in the Bloomberg Emerging Market Index, which according to some calculations could bring in another $3 to $4 billion over the next couple of quarters. The one that is awaited is the Bloomberg Global Aggregate Index, which is a far bigger index. But a lot of people think about this as a stepping stone towards inclusion into a bigger index. So if over time we are going to see a series of inclusion, then yes, I think the sort of magic we used to see in terms of portfolio inflows into equity markets, like last year it was $25 to $30 billion. We could see that kind of magic in bond market, right over the next 1 or 2 years. So I think that is interesting. But taking a step back, what this really means is that the rupee is extremely well funded. My magic number is $25 billion. If we get this extra inflows of $25 billion from somewhere or the other every year, then our balance of payments goes into a big surplus and the rupee becomes extremely well funded. Last year it came from equity markets. FY25, I think it'll come from bond markets. And then I think from FY26 onwards, it'll come more from FDI inflows. And that is another interesting part. FDI inflows into India have slowed, but my own sort of work suggests that in a 2-year horizon, they'll start to pick back up. And not just that, they will double. And I'm saying that because I track a lot of foreign investment intentions data into the country. And there are a lot of intentions into futuristic sectors from semiconductors, renewables, green hydrogen, AI, and I think all of that money will materialize in a 2-year horizon. So the rupee remains extremely well funded.
Pranjul, whenever you have the time, would love to do a slightly longer conversation on this particular aspect that you just mentioned, hopefully from our studios. But it always lovely talking to you. Today was no different. Thank you for joining us. I much appreciate your time.
Thanks for having me.
All right. That's the view from Pranjul Bhandari of HSBC.